Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Fatakia. We come back after a big break to Nifty surging by around 200 points. What a move on the IT names today as well. Infosys being the top gainer. We are going to talk a lot more about it in just a bit. But yes, it's a green looking screen across the board. All four major indices that you'll see at the top of your screen seeing major gains as well. Almost an 0.8% gain on the Nifty. Mid caps are slightly underperforming, but it is not really an underperformance. There are still gains of around 0.6%. Banking names in line with the benchmarks. You do have Infosys as the big gainer, so Nifty IT, that one is up around 3% as we speak. FMCG is the other one following suit, and of course we have HUL's numbers which will be out in any time now actually, so we are waiting by for that. We have the private banking and the PSU banking names doing well, so across the board it's a green looking screen barring Nifty oil and gas. That one is down 0.3%. So all round good performance coming in, or I would say a performance in the green from the markets today. Not many earnings that we have to track in terms of what was reported over the weekend or over the holiday season, but we do have some of them which will be reporting numbers today. HUL, and tomorrow we do have Dr. Reddy's which will be on our radar as well. But mid caps, they are doing well. So Hormuz has gone across to the big wall. He's going to put spotlight on top movers in the market now. Hormuz, tell us more.
Well, for a change, the color of our outfit is matching what the markets are doing today. But yes, there is some optimism with regards to the trade deal between India and the US, and that's showing up on the stock prices of a lot of these export-oriented companies, be it textile names, be it the shrimp feed companies. Gokaldas Exports was up 12%, Apex Frozen was up 12%, Vardhaman is also nearing double digits worth of gains, but look at the volumes here. Gokaldas is at 21 lakh shares, trade hands, it's 20 times higher than its 20-day average. Apex Frozen has had 10 lakh shares being traded already. The 20-day average is only 21,000 shares, and same is the case for Vardhaman as well. It had close to 70 lakh shares being traded. The 20-day average is only 40,000 shares here. You spoke of IT names, and it's mid-cap IT that is dominating proceedings, barring Infosys, of course. And Birlasoft now is up 10.5%, the biggest single-day gain since May of 2021. The volumes already are the highest in the last 4 months. We have had more than 70 lakh shares traded here as well in Birlasoft. The 20-day average is only 2.5 lakh shares on very, very strong volumes as well. The stock breaking above its 50-day moving average of 366 and is now nearing its 100-day moving average, which is at 391. That's the next important level to watch out for. And with this move, the stock is now turned positive for the month of October, which is now turning out to be the first monthly gain after 3 months of losses for Birlasoft. Has been an underperformer so far, is down 32% this year. EPAC Prefab is also down around, is up around 17%. Earnings reaction, it's a recent listing. The stock significantly higher than its listing price, and on the volumes too higher than the listing day. And Shipping Corporation as well, the third straight day of gains, and the stock doing very well on very strong volumes. Over to you for HUL.
All right, thank you for that. Yes, big breaking in terms of HUL's numbers. We have the net profit, which is coming at 2,694 crore rupees, which is higher than the poll at 2,480 crore rupees. Even the revenue number is at 16,241 crore rupees. The poll, in terms of the number that was expected, was at 15,850 crore rupees. So it's a top-down beat so far. The profits higher than the poll and the revenues higher than the poll as well. As per the poll that was suggested, the underlying volume growth was seen between 0 to 1%, so that will be an important number to track for HUL. For now, the stock has surged to the day's high. It is up 2% on that beat that has come in on revenues and profits. In fact, let's go across to our colleague Mangalam Malu, who's standing by with the initial review. Mangalam, what did you make of these numbers?
Well, these prima facie look like they are better than expected when it comes to the top line, the EBITDA, as well as, the bottom line as well. So looks like the first quarter of Priya Nair has flagged off in style, and quite the contrary to what the company had said in its quarterly update as well, when they said that, the business will actually see flattish sort of growth. So it implies that maybe towards the end of the quarter, there was a big jump that came by. Now all eyes will be on two numbers. One, the volume data, and the second one will be the outlook that the management has for the second half of this year, largely on account of recovery coming in on the GST cuts that have happened and the festive season demand. I'm looking at the EBITDA, the margins coming in at 23.2% as well, slightly higher than the company's own guided band of 22 to 23%, but more importantly, much above the street expectations of 22.5% as well. So all these factors working well for HUL so far. These numbers slightly better than expectations. We'll get some more details and come back to you, but prima facie looks like a mild beat.
So, Mangalam, just a correction there. The revenue that was flashed earlier was the consolidated number that was above 16,000 crore rupees. We do have the standalone revenue number, which has come in at 15,585 crore rupees. The net profit, of course, remains same at the 2,690 crore mark. So the revenue is slightly lower. I wouldn't say it's lower, but it's a 300 crore difference versus the poll. We have the EBITDA, which is absolutely in line with the estimates at 3,563 crore rupees. And the margins have come in at 22.9% versus a poll of 22.5%. Is this still a better number? And of course, as you said, we are awaiting the volume number and the outlook commentary coming in from the management as well.
Well, it is still, one cannot complain on these numbers, largely because the street was ready for these numbers. The company had given their update already. And the difference between consolidated and standalone for HUL over the last 2 quarters, what has happened is that consolidated has taken a little bit of precedence when it comes to the headline numbers as against standalone, on which analysts do make their poll. The difference between those two, the 300 crore that you're talking about, is largely on account of the Minimalist acquisition that the company had done. So when the acquisition of Minimalist had happened, it was supposed to add a few percentage points, just about 1% or 2%, to the company's overall revenue, and that's what is reflecting in the consolidated numbers. So on an organic basis, the business is flat, and that's exactly what the company had guided for as well. So it's not that the street was underprepared for it, but it's just that the analysts are still yet to update their models, and we are expecting some sort of numbers coming in on their volumes as well right now. But on a consolidated basis, 16,240 crores and the revenue of 15,500 odd crores on a standalone basis, largely in line, if not a positive beat. Now, forward-looking statements will be a lot more important than the numbers that have come by.
Indeed, we'll watch out for those forward-looking statements, as just that flash at the bottom of your screen was one-time gain of 184 crores on the numbers as well. But as of now, it seems to be a largely inline set of numbers compared to what the company had already shared in its business update earlier. Deven Choksi is now joining in for a quick review of the numbers. Deven, thank you for joining in. Would you say that the numbers are not as bad as the street was fearing, or what HUL had shared in comparison to its business update earlier?
Yes, good morning. Well, I think the top line is bang on target. I think more or less the same number was expected. That means that company has delivered both on the volume as well as on the value front as far as the top line is concerned. The key differentiator, I think even if you remove that one-time gain of 184 crores, I think the key differentiator seems to be in the margins. I believe that the market was probably expecting the fall in the margins largely because of the cost factors on some of the key input materials, particularly in the food category. I believe that that has probably not come as much as it was feared about. And as a result of which, we are seeing the better profit numbers than what probably we were anticipating. Maybe I'm yet to see the complete breakup of EBITDA. If I see the EBITDA, probably my conviction would go further into this argument that we are making currently. But overall, the numbers are like Nestle. The numbers are quite upbeat and promising for the coming quarter that we are expecting.
So the EBITDA has come in at 3,563 crore rupees. The poll threw a number of 3,560 crore rupees. Margins at 22.9%, largely in line with the 22.5% margins that there was there. Deven, the stock has come up from the highs. Is amongst the consumption pack, is HUL your topic? What are the other stocks which you like versus HUL, or do you think this will continue to be the big growth story?
Yes, this continue to be remaining a strong story, particularly because of the fact that in each and every product category, they have probably started using the AI for demand generation part of the activity, and as a result of which the production process has been quite rationalized, as I would call it as, along with the distribution. So gone are those days wherein these companies used to produce in anticipation of market demand. Today, they are using the AI to predict the market demand, and as a result of which, those desperate sales and discounts, have gone away, in my viewpoint. And that is reflecting into the profit margins, even though the growth is remaining slightly tapered off in this period. But overall, both Nestle and HUL, both of them are indicating that the consumer demand is back. And once we see the detail from tier 2, tier 3, what exactly have contributed, probably I think this could get validated. But overall, I guess I think the numbers are pretty much in line. Though I think the market appreciation point of view, the stocks may not perform as smartly, largely because of the valuation at which they are quoting currently.
Deven, thank you for joining in for a quick lowdown of HUL's numbers. We'll go back to Mangalam for another quick update on the numbers. Mangalam, tell us more.
Well, a couple of things that stand out in these numbers as well. If you look at the P&L, the advertising expenditure has gone up year on year. It's slightly more than the revenue growth itself. So which tells you that the company has not cut back on its advertising to protect margins. And in light of that, 40 basis points beat on the margins is a mild positive. The other thing is that if you look at the segments, home care has been a mild decline as against 3 to 4% expectations of growth that the street was expecting. But that has more than been offset by a flattish performance in beauty and well-being and a mild growth in both personal care and foods. Remember, in personal care, foods, as well as beauty and well-being, the street was working with a bit of a decline. Out here, the fact that it is flattish, it is offset the flat performance that is coming on home care as against a growth of 3 to 4% expectations as well. So this seems like a broad-based performance that is coming from HUL this time around. Low single digits, obviously flat performance, which was expected on account of a couple of factors. The GST transition and the first half of the quarter had unseasonal rains and flooding in many parts of the country as well. So all in all, goes down as an in-line to mild positive set of numbers for HUL. The rest depends on the volumes and the commentary coming in from Priya Nair.
Take that point. Thank you so much, Mangalam, for explaining those numbers to us. But as you pointed out, the volume growth and the outlook going forward will be the next important things to watch out for as far as HUL's numbers are concerned. That's about HUL, one of the biggest gainers on the Nifty. But the big story of the day has to be the rally that we are seeing in Infosys. And it's not just limited to that, but most IT companies or the stocks are surging in trade today. Rima is here to help us understand what's really happening here and why is that happening. Rima.
Well, a couple of reasons, but let's start with Infosys first. The promoters have said that they will not participate in the 18,000 crore buyback. Promoters hold about a 13% stake in the company. Now, when the promoters don't participate, increases the acceptance ratio for the remaining shareholders. And just as a recap, Infosys it's a tender buyback at 1,800 rupees per share, and it accounts for 2.4% of the overall equity. Now, the question is, are the promoters not participating in the buyback because they have, they're bullish on the long-term prospects? Maybe that's so. But also, is it on account of the tax considerations? Because now we know, as per the new rules which came into effect, the deemed income from dividend is treated at the highest tax slab, which basically makes it inefficient for high net worth individuals, i.e. the promoters. So is that a consideration that went into the promoters saying they won't participate? But secondly, there is also a sentiment booster for the entire IT sector because of the clarification on H-1B visa. Remember, H-1B visa fee was hiked to 100,000 for new visa holders, applicants, basically. But if you are a student on F1 and you want to get an H-1B visa, it's not applicable to you. If you are on H-1B visa but you want to change your job, then it's not applicable for you. And again, it's only for the new applicants. So some clarifications have also provided some, calm in the overall season. And generally, the IT earnings season was not bad in Q2 compared to muted expectations. The Nifty IT index itself is down 16% on a year-to-date basis, and it's 21% away from its 52-week high.
Indeed, Rima, thank you for that. The big story on IT names, Infosys, of course, leading the pack, almost 5% higher. And we just spoke of Birlasoft as well, now trading with gains of almost 9%. As we speak, take a short break, put the spotlight on the crypto markets with Multi-Coin Capital's Kyle Samani on the other side.
Coin DCX.
Welcome back, and as promised on Crypto Corner, we are now joined by Space Multi-Coin Capital's co-founder and managing partner, Kyle Samani. Kyle, hi, thank you so much for joining in. Well, to begin with, what are your views on the digital asset treasuries? That seems to have done quite well in the current year, 2025.
I launched Forward Industries a few weeks ago because I believe there's an incredible opportunity to build a new kind of publicly traded permanent capital vehicle in the crypto space. I was very fortunate to partner up with the folks at Jump Crypto and at Galaxy Digital to come together as a sponsor group to launch this new initiative. And we are really looking to leverage our brand, our relationships, our access, and our understanding all over the crypto industry to deliver excess returns to our shareholders above and beyond just holding native Solana.
Kyle, what would you say is the growth of the industry on an year-on-year basis? Because many of the crypto prices have been surging. We also have seen some positive regulations. And then apart from that, the ETF buying has been very strong.
I mean, I think if you look at most of the major metrics, everything in the industry is kind of up 2, 3, 4, 5x over the last year, depending on which specific number you look at. But when I really think about the growth story for crypto, I think about the major legislation that's come out of the United States specifically. As you probably know, the United States Congress passed the Genius Act a couple months ago, and that act, authorized stablecoins to be issued all over the world. I think when we look back in 20 years, we're going to look at 2025 as kind of comparable to 1996 for the internet. In 1996, the Congress in the United States passed the Telecommunications Act of 1996, and that really laid the foundation on top of which the modern internet was built. Similarly, I think the legislation that's come out of Congress this year is going to really provide the foundation on top of which the crypto industry around the world is going to boom over the next 20 years.
Kyle, when you talk about regulations, the US, as you said, seems to be doing some path-breaking work right now. But would you say it's time for other countries to collaborate when it comes to regulations and the work being done?
Oh, absolutely. It's always better for users and for businesses for regulations to be more harmonized around the world. I was actually in Washington, D.C. a couple weeks ago meeting with Speaker Johnson there, and he was talking about his coordination with other speakers and members of Congress from around the world. So I'm optimistic that it's happening, and it certainly will be very good for industry.
Crypto on the blockchain is called the future of internet from where we stand right now. So when it comes to capital markets and permissionless future going forward, how far would you say we are from seeing that seamlessly transparent, even credible?
I think it kind of depends on who you are and where you are. I think actually the U.S. will probably be one of the last places where normal consumers are holding crypto and know they're holding crypto. But I actually think people in a lot of countries around the world are very excited to use crypto because they understand the benefits of being able to hold $1 in their phone without having a bank account and all the traditional overhead that comes with the bank account. If you look at the data today that's published by groups such as Chainalysis and others, what you see is retail users who are adopting and holding and using crypto all over the world are predominantly outside the United States. And I expect that to continue to be the case.
How would you also rate the mergers and acquisition activities within crypto? Has that seemed to be picking up, especially in the current year?
I'd say mergers and acquisitions, there hasn't been too many companies historically in crypto to be acquired at scale. And that's because most of the most famous crypto companies issued a token. And kind of by issuing a token, you generally take yourself off of the path of M&A. If you look at most of the acquisitions, companies like Coinbase have done, they've mostly been picking up kind of small teams here and there. It does seem like we're in kind of a wave of acquisitions happening now, especially with this new flock of companies that are going public, companies like Circle and Gemini and BitGo and others. And I think a lot of these companies are going to use their stock as currency to complete more acquisitions, probably mostly for bolting on new lines of business.
Kyle, and finally then, how are you strategizing 2026? What is your vision, whether it's about regulations, prices, or even the new scalabilities coming forward?
Yeah, I spend a lot of my time these days working with multi-coin portfolio companies, as well as with our team at Ford Industries, planning a lot of initiatives of ways we can drive new kinds of user trading and on-chain activity on Solana. There's a number of really cool acquisitions out there and a number of new apps that are being developed that we think are going to drive tens of millions, if not hundreds of millions of new users onto Solana over the next year. And so figuring all that out has been my primary focus, and I think it's going to be an incredible 2026.
All right. Kyle, what a pleasure talking to you. Thank you so much for making time for us today. Well, with that, let's step into a short break. On the other side of the break, we will talk about markets and some stock specifics.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. On to corporate conversations then. Karur Vysya Bank, it was a mixed quarter for them with the net interest income and profit rising, but the asset quality continuing to remain weak amidst the one-offs, as the management mentioned. Now, to discuss the quarter gone by and the way forward, we are now being joined by Mr. B. Ramesh Babu, who is the MD and CEO at Karur Vysya Bank. Mr. Ramesh Babu, thank you so much for joining in. You take us through your NIMs first, sir. Your guidance continues to remain between 3.7 to 3.75. At the end of the first half, it was at 3.8. Now, does that indicate that there is still further room for compression for NIMs going forward, or do you believe that the NIMs have bottomed out and they will improve in the second half?
Thank you. Good morning and happy Diwali to both of you. And before I just commence, so I'll just share one good thing what all happened in the bank. During the quarter, we have crossed 2 lakh crore total business, which is a landmark number for the bank. And it took 100 years for the bank for the first 1 lakh crore. And now we are able to grow every 4 years 1 lakh crore, which will be condensed further. So that way, if you can look at it, the highest profit in a quarter also we have got during the quarter, this quarter. That way, it's a historic quarter. Coming to the NIMs, what you say. Agreed, we have given 3.7 to 3.75. But what sort of efforts we have to make to contain the loss of business. Particularly, there's a lot of competition going on there. So that way, we thought that we may have to leave few of the businesses. And the next thing is RBI rate cut also is not known. That is the reason conservatively what we thought. We will go for 3.7 to 3.75. But somehow I feel that we will be above that.
Okay, all right. So you feel that there could be an upside to the targets that you have on net interest margins. Mr. Ramesh Babu, happy Diwali to you as well. You were able to contain your overall OPEX or operating expenditure this quarter, especially employee cost. And cost to income is also just at 42.6% now as per the numbers, lower than 47% levels that we have seen so far in last couple of quarters. Was it a one-off, or will this be the level that we can continue to see going forward as well?
Yeah, what you said is correct. Because it's a one-off, one recovery is for 295 crores, we have got it. So it's at 42. So if you do not take that into account, it comes to around 45. Even then, we'll be much below the 50 what we have guided. So somehow we feel that. So with the investments what we are making, we'll be able to continue the cost to income around 50 or below 50.
Mr. Ramesh Babu, about your asset quality, sir, you had mentioned your provisions because of the higher slippages, and 2 accounts turned NPAs this quarter. Tell us more on this, because are you confident that there will be recoveries from this in going forward, and where do you see the asset quality picture by the end of the year?
Just I want to share one thing. We have 2 lots if you look at it, other than corporate and corporate. Other than corporate, where the pain everyone is feeling, actually we are at the lowest. If you can look at our total SMA 30 plus is also 0.27. Even the corporate 2 accounts which have become NPA, if you look at last 2 years, the net slippages is between 0.2 to 0.3. So this time what we thought is, so this has been going on for some time. We gave some sort of a rope to them. When we found saying that it may not work, it is better we bite the bullet and all, so that the enforcement measures you can start much in advance. So that's why a conscious call has been taken. But the blessing in disguise is we are able to recover 295 crores in the quarter. That's why without rocking the boat, management is able to manage the whole show, and ROI of 1.81, which is again the highest, we are able to show that. So that way, I am assuring that the portfolio is clean, and corporate also we do not have much big exposures. And the last point I want to convey is above 150 crores we have brought down. So substantially. 2 years back, if you look at it, it was 3% of the portfolio. Now it has come down to 1.5%. So that way we are actually de-risking the portfolio. Even if something happens, it should not hit the whole balance sheet.
So you are saying you are reducing your exposure to corporates. Am I reading that correctly?
No, reducing the corporate to high value corporates above 150 crore.
Got it. You know, your loan growth was healthy, specifically led by RAM. You did see strong growth in lab jewel loans as well. Is this something that will continue? What is the loan growth target?
Yeah, that will continue that way. If you look at it, actually the growth in retail is around 22% year on year. Agriculture is also growing well. We are very strong in the gold loan segment there, and commercial is also growing well. First of all, the focus will be because there is still a slight element of stress is there on the liability. When I talk about stress, the quality of the deposits, what you get, majority of the deposits are coming in the time deposits, not much in the CASA. That way the costing will be relatively high. So that's why we are going slow on the corporate where the yields are low, and we are placing more money in the RAM. Tomorrow, the deposits normalcy restores. We may increase the corporate also, but for the time being, 86% is RAM. That will continue, and a lot of growth is there. Commercial, compared to last year, the growth in the disbursements is around 35%.
So in that light, Mr. Ramesh Babu, you had earlier mentioned that you have reached 2 lakh crore worth of business. Does your loan book, since your loan growth was healthy this time around, does your loan book now grow to 1 lakh crore by the end of the year? Fair to say that?
It looks like that.
If you could give us a target, sir, are you expecting that to happen? Are you confident of that?
The target, what we have told the market is we will be above 2% over the industry. Well, the industry is growing at 11, we will be at 13. But if you look at our current position itself, the RAM itself is growing at 20%. So engine is well, but it depends totally on the liabilities flow, what we are going to get. That too, CASA, if it comes well, growing 16% is not a big problem for the bank.
16% is not a problem. Last question before we let you go, if you could just reiterate the NPA number that you have in terms of target this year, because this time around we did see gross NPA see an increase by 10 basis points. What is the comfortable level that you have in mind?
In fact, we have given a guidance of gross NPA of 1.5, but it may not reach that level. So you have been seeing consistently our gross NPA has been coming down. Even net NPA also, you see, with all these big hits we had in the last quarter, our net NPA still holds at 0.19. So the quality of the book and the balance sheet is still maintained. We feel that gross NPA also will be under control, but we gave to the market 1.5 gross NPA and 1% for the net NPA. These are the upper limits, but we will be much, much below that.
All right, Mr. Ramesh Babu, pleasure having you as always. Thank you so much for sparing time and joining us. Wish you good luck for the second half and festive greetings to you as well as the management of Karur Vysya Bank. And we take a short break. Just before we do that, a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the line graph. Now, this is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameters considered for the calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or a sell recommendation. Any investor or viewer interest is advised to carry out a necessary due diligence on their own or through a certified registered financial advisor for their investment decisions.
Welcome back. You're still tuned into Trading Hour. Markets are slightly off from the day's high, but let's get in Sudarshan. He's bringing us the latest trends from the F&O space this morning. Hey, Sudarshan.
So it's turning out to be a good day, and the biggest positive part is the market is holding on to gains despite a big gap up opening that we have seen, and its Nifty remains around above the level of 26,000. Now next resistance comes for Nifty only around 26,135, and if we manage to cross that, then it would be like around record high of 26,277. And the biggest positive for today is the support is coming from all the IT stocks. Infosys top Nifty gainer up more than 4% after the news of that promoters are opting out of the share buyback, and big gains are coming for Tech Mahindra and HCL Tech as well. Reliance has come off highs. Now it's in the red, and it was in the first hour of the trade. It was amongst the top Nifty contributors, but has turned negative on the news related to that Russian oil imports are going to come down. As far as put call ratio is concerned, it has moved higher to 1.19 versus 1.08. Now, if you take a look at the options data, 26,000, 26,100, huge increase in the open interest, but at the same time, premium has fallen sharply. But on the call side, the interest is now being seen in 26,200, even in 26,500, where we are not seeing only increase in the open interest, but also premium for all these three call options, 26,100, 26,200, as well as 26,500, premium has moved sharply higher. So now support for Nifty would be around 25,870, and first resistance, as I mentioned, would be 26,135, and next comes around record high of 26,277. As far as Nifty Bank is concerned, support 58,150, and resistance would be 58,600. I've taken few stocks. First one is IDFC First Bank. Majority of the banks are saying fresh buying. IDFC First Bank, Indian Bank, Axis Bank, all these three banks, even they had put out earnings. Those were strong and much higher than expectations, and these banks continue to see fresh buying. One stock that continues to see fresh shorts is Dixon Technologies.
Dixon Technology is continuing to see fresh shorts after that downgrade from CLSA earlier in the week. Sudarshan, thank you for that update. Siddharth Raimangla of Stockbox Technologies is joining in for a quick chart check. Siddharth, thank you for joining in. Yeah, it's still there and thereabouts when it comes to the record high levels. But A, does 26,000 sustain? And B, do we get to record highs by the end of the month? Follow that up with your stock calls as well for the morning.
Yeah, sure. Hi, Hormuz. Good morning, and thanks for having me on the show. See, Hormuz, if we talk about Nifty, two very special things have happened in the index today. Specifically, initially around the market opening, Hormuz, there was an attempt in Nifty to cool down a bit, to correct a bit, but 26,000 acted as a very, very big support. But and then additionally, just as Sudarshan mentioned here, in the options data, we've seen a massive increase in put writing positions in the 26,000 strike price. And at the same time, on the other hand, 26,000 call option has seen a reduction in open interest. So now 26,000 is the new big support for Nifty from here, which is why I don't think there will be too many big or sustainable dips in Nifty from here. Yeah, yes, definitely we can see a brief consolidation because there has been almost a one-way up move in the past 6-7 sessions. There can be a brief consolidation, but eventually I think we'll be seeing Nifty moving towards its all-time highs in the next few sessions, and probably even beyond that, beyond the all-time high towards the 26,400, 26,450 level.
Okay. What about individual names, Siddharth?
Yeah, sure, Sonal. Hi. See, two stocks are on my radar. The first one is Phoenix Mills. This one we have to buy. There was a very good breakout last week in this stock, but we could not see a very good follow-up move here. But today, there is a fresh move which is building up, which can take the stock back about 1,700 towards those 1,740, 1,750 levels. So Phoenix Mills can be bought right now in spot. The price is around 1690-ish. It can be bought. The stop loss will be at 1670. And our targets being the first one, as I said, 1740. Second one being 1760. The second stock is Siemens. See, again, for the past 6-7 sessions, there was a consolidation in this counter, but today, with a very strong up move, there is a very beautiful breakout, which can take the stock towards the 30 to 50 mark. So Siemens can be bought in spot right now. The price is around 3170. We'll keep the stop loss at 3145, and our targets being the first target 3250, second target 3270.
Siddharth, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Take a short break, continue conversation on the markets with Nikunj Doshi from Bay Capital on the other side.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's talk about the oil and gas space now. Some international update that has come by. Now, remember, US has sanctioned Russia's two biggest oil companies. One of them, of course, is Rosneft. The other one is Lukoil, which has been done to pressure Moscow to negotiate a peace deal with Ukraine. Now, do remember, last year in July, European Union also had sent a communique where they had sanctioned Rosneft and a lot of other oil and gas companies in the Russian region. And European Union restriction on operations of Rosneft's 20 million tons per annum refinery in India as well. There's UK as well, which had done it last week. Now, why is it important from an India perspective? Because remember, Rosneft, which is a Russian state-owned oil corporation, it has 49.13% stake in Nayara Energy, which is a private Indian refiner. It has the second largest private refinery in the country with a capacity of 20 million tons per annum. Now, Nayara Energy, as of September 2025, which is the latest data available, relied entirely on Russian crude oil imports. This is because of the sanctions that had come by. So they lost access to other crude sources, the ones that we have in Iraq and Middle East as well. At the same time, crude imports fell 22% on a YOY basis to 330,000 barrels per day in September 2025. And exports also, they dropped from around 210,000 barrels per day to 89,000 barrels per day on a YOY basis. So they not only saw a decline in imports from other regions, they also saw an export decline because of the sanctions that had come by. Now, do remember, they largely export to countries like Middle East, Turkey, Brazil, etc. Now, Nayara Energy earlier, when these sanctions had come last year, did indicate that they will be seeking assistance from government to navigate challenges posed by the sanctions. And we did speak with M.K. Surana today, and he indicated there will not be much impact because of the sanctions that have come by as well. So important update that has come by.
Important update indeed, and we'll get a view quickly in from Nikunj Doshi from Bay Capital before we go across to the management of HUL. Nikunj, thank you for joining in. What do you make of this recent update coming in? Before we get to Nikunj, let's go across to the management of HUL.
And unlock opportunities for premiumization across categories. However, in the short term, these changes led to transitory disruption across channel as trade partners postponed orders to clear existing inventory. Additionally, consumers delayed pantry replenishment in expectation of lower shelf prices. These factors, coupled with pricing volatility arising from multiple prices in the market, has resulted in a short-term impact on sales during the quarter. In this backdrop, we delivered competitive growth with a consolidated turnover of rupees 16,061 crores, resulting in 2% underlying sales growth and flat UVG. Gross margin stood at 50.9%, almost flat year on year. We have stepped up investments in our brand and business, resulting in a year-on-year increase of circa 80 BPS in our A&P spends. As a result, EBITDA margin at 23.2% saw a dilution of 90 BPS versus September quarter 24. Profit after tax before exceptional items was down 4% due to lower EBITDA and a decline in the net finance income stemming from our strategic capital allocation decisions. Profit after tax grew by 4%, primarily driven by one-off positive impact pursuant to resolution for prior year's tax matter between the UK and Indian tax authorities. From a first half perspective, we delivered a USG of 3%, led by 2% UVG. EBITDA at 23% was down 110 BPS year on year, in line with our previous guidance. PAT BI declined 4% while PAT grew 5%. Considering our performance in the first half of the year, the Board of Directors have declared an interim dividend of Rs 19 per share for the year ended 31st of March 26, translating into a total payout of 4,464 crores. Moving on to a segment performance for the quarter. Home Care continued to strengthen its market leadership in the quarter. Mid-single-digit UVG translated to a flat USG on account of price reductions taken previously. Fabric Wash delivered mid-single-digit UVG, while Household Care delivered double-digit UVG. Our liquids portfolio continued to perform well, delivering sustained double-digit growth. Beauty and Wellbeing delivered 5% USG, driven by robust growth in skincare and health and well-being, which was partially offset by transitory GST-led impact in hair care. Hair care continued to strengthen its market position, albeit witnessing a decline of turnover in the quarter. Skincare, including color cosmetics, grew in high single digit, driven by continued momentum in the future core and market makers portfolio and a well-executed winter loading ahead of the season. Health and well-being maintained its strong triple-digit growth trajectory, and channels of the future sustained its competitive double-digit growth momentum. Personal care turnover growth was flat, impacted by GST rate transition. Skin cleansing delivered a competitive performance underpinned by strong double-digit growth in premium soaps. Oral care witnessed a marginal decline, while close-up delivered low single-digit growth. Foods delivered 3% USG with low single-digit UVG. Beverage portfolio comprising tea and coffee delivered double-digit growth. Within that, tea grew in high single-digit with positive UVG. Coffee continued to deliver double-digit growth driven by pricing. Early green shoots were observed through sustained UVG in lifestyle nutrition, while turnover declined, led by pricing actions taken in the previous quarters. Packaged foods delivered a subdued performance amid GST transition. Ice cream turnover declined year-on-year on account of prolonged monsoon in parts of the country and GST transition. We remain firmly committed to accelerating our volume-led growth through 4 key priorities. Number 1, radically sharpening segmentation of portfolio, channels, and media play for different consumer cohorts. Second, being bolder in transforming our core brands to make them more modern, desirable, and youthful. Third, future-proofing our marketing and sales capabilities by enabling superior online brand discovery and fulfillment. And fourth, investing disproportionately to scale our high-growth demand spaces. These priorities, combined with supportive macroeconomic environment, will position us to accelerate competitive, volume-led growth in mid to long term. Looking ahead, the GST-related transitory impact continues into October, with normal trading conditions anticipated early November onwards. If commodity prices stay within the current range, we expect a low single-digit price growth. Overall, we anticipate second half of this financial year to be better than the first half. Our EBITDA margin for the upcoming quarters is expected to remain in the similar range, excluding ice cream business. Ice cream business operates at a margin lower than actual average. Consequently, the demerger is expected to result in an improvement in our overall EBITDA margin going forward. We remain committed to executing our strategy with sharp focus and agility, prioritizing competitive, volume-led growth across our portfolio. With this, we complete our prepared remarks. Now we can take questions.
Okay, Nitesh, Priya, hi, and Priya, good to be chatting with you. Congratulations on the quarter. And contrary to the update that we've seen, the numbers are seemingly good. So you did say that by November you expect the GST impact to slightly lift off. In light of that, what is the outlook on volume growth, volume recovery, anything you could share on that?
Yeah. So as you mentioned that both elements, the work on overall work we've done in the portfolio, transformation, the 4 key priorities, improving macro conditions, and GST transition, which will start getting stabilized from early November onwards. We do expect our second half of the financial year to be better than the first half of financial year. And our focus will be squarely on volume-led growth.
Right. Congratulations, Priya, on the appointment, and congratulations on the elevation, Ritesh, as well. Your first, your last, interaction that we are having. I have a 2-part question for Priya, and the question is basically from a very near-term, immediate term, and the long term. So in the very near term, if you could tell us, secondary sales, how was October festive season? How has it panned versus your expectations? And because of the GST rate cuts that have happened, what are the incremental volumes that you're anticipating over and above what you were earlier as well? Because, before the cuts, you all were saying that the second half will be better than the first half. And in the long term, the medium to long term, what's the strategy to structurally uplift volume growth and revenue growth over what we've seen over the last 3 years?
Let me start with the structural shifts that we will make and our focus. We will be obsessed with volume-led revenue growth. This will be our focus, our obsession. There are 4 pillars we will focus on as a strategy in the future. The first is that we will segment radically our consumer segments in India. There are distinct consumer cohorts emerging in India: power spenders, premiumizers, and democratizers. And with our price portfolio, which spans across the pyramid, we have a unique opportunity to serve all these emerging segments in India. We will future fit our marketing and sales frontline machinery. Our marketing will become much more social first demand generation, and we will invest in ensuring that we are investing behind quick commerce and e-commerce. We will radically transform our core brands, making them more modern, youthful, contemporary. This will be our focus. This, along with investing disproportionately behind a few high growth segments to scale them and make markets in India, will be our priority and our focus. So really simply, volume-led revenue growth is what you should hope for in the future from us. Ritesh, you want to take the
short term
first?
here and now, let me just talk both the quarter gone by and then what we see going forward. If you look at the quarter gone by, September quarter, I'll put into three different portions. 40% of the business was benefited from GST rate change. There is, of course, a short-term transition impact which we spoke about, and hence categories like hair care, skin cleansing, they saw the impact coming in. Hair care has grown very strongly for us for the last several quarters. It is competitive growth this quarter as well, but headline growth has got impacted. Same is the case for skin cleansing. So 40% business saw a short-term impact coming in. 20% business, which is, let me say, skincare, tea, there was no change in GST. We saw these businesses growing in high single digit, also supported by volume growth within this growth. Third, last 40% business is our home care business, where we saw a mid-single digit volume growth on the back of a strong high single digit volume growth in the base. Overall, this volume growth was muted, and we had a flat growth of USG because of the price declines. Today, commodity headline crude is almost 10% lower year on year. Plus the competitive actions we took, which we spoke about it earlier, put together had a negative impact of pricing on home care. So this is how the 2% growth for the quarter has come out. Then to answer your question on what do we see October onwards, clearly once things stabilize early November, there are multiple prices in the market, old MRP, new MRP. Of course, with all the amount of support that we have given, this will stabilize in the market. We do expect that typically for FMCG business, two things are important. Yeah. The net overall disposable income, which consumers have, and the consumer sentiment. GST will end up supporting both of them. So we do believe that we will start seeing a recovery of volumes going ahead.
Right. So do you have a quantifiable target when you say volume-led growth? Because a large part of your business obviously impacted by macros, but a small part of your business, which is growing fast, is immune to macros. If you could give us a quantifiable target that you have here.
Yeah, we will maintain the range guidance that we've always given you. I think what's important to understand is how we will manage pricing as we go along. Pricing, we will continue to be in line with the way commodities are diverging. When you look at our commodities, we have commodities like Ritesh mentioned, like crude, like tea, which are deflationary, and other commodities like SMP and palm oil, which are inflationary. So we will continue to be gradual in our pricing, really focusing on volume-led revenue growth.
Mid-single, high single, any sort of quantifiable targets?
We will stay in our range guidance.
Priya and Ritesh, both congratulations to both of you. I think, Priya, what I wanted to ask you is that, you've led...
Right, that's the word coming in from the HUL management. They will be obsessed with volume-led revenue growth. That's an important statement coming in from them, and they'll transform their core brands as well. But for that, we are completely out of time on this edition of Trading Hours. Stay tuned. Halftime Report is up next with all the market action.